On this episode of MLO, we're going to cover the 3 ways to improve your finances in 2021.
Oh, did you just snap the finger? Oh, that was a great add-in.
Perfect timing.
I had to.
Good timing with that.
So today we actually have a special guest.
We do.
Who just snapped his fingers, Mark Meek. Say hello, Mark.
Hello, it's great to be back. Third time's a charm.
Mark's a veteran guest here on MLO, Brie.
Yes.
But this is the first time you've been
Experts.
able to be on the show with him.
It's my first time with Mark, so I'm so happy to have you here. Thanks for coming.
Absolutely. It's going to be fun.
So Mark is a financial advisor. Do you have anything else you want to add to your intro? I don't want to steal your...
Financial advisor, father, husband. That's pretty much all I got time for nowadays.
You're a great dad. We know that.
15 handicap. That's about it.
You're down to 15 now.
That's
Good
right.
for
It
you.
was 28 last
You're going to have
year.
to start
Wow.
giving me strokes pretty soon.
Not yet. We'll get there.
Well, I want them. And if you're willing to give them, I'll take them. So, Brie, what are we talking about today?
Today we are talking about debts, and we're talking about how to manage them and how to manage our wealth going into 2021.
Yeah, it's really big. With 2021, we're almost 2 months through the first year here, maybe a little further by the time you're watching this. Title of the show, actually, for this episode, 3 Ways to Improve Your Finances. And the original article that we reviewed and dissected and wanted to share had 5, but we're bringing it to 3 kind of just standard, solid, get on base hits. Right, Mark?
Yes, sir. Keeping it simple.
I put a sports little thing there. I don't know if you caught on.
I caught it. Got me in the zone.
Oh my gosh, too fun. So 3 together, super important, rather than 5 or
Right.
10 or 10 things you need to know about, blah, 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 which is really tough to bring together. We're going to focus on the top 3. And the first one is really the consumer debt. So everyone out there might hear that term consumer debt. What does that mean? It's what we owe as citizens, I guess we'll say, credit card debt, auto loans, student loans, your mortgage. These are all money that we owe back to somebody. Right, guys?
Right.
So I wanted to really dive together with Mark basically to hear his perspective as a financial advisor.
Yep.
How are you walking through and prioritizing debt? Because I have to hold the reins back on myself because I'll go into like credit card debt and this and do that. But I want to hear from Mark's perspective, how are those conversations going with your clients?
Yep, absolutely. And I'm sure we've all been in a place where we've had some credit card debt that we weren't necessarily proud of, or kind of wake up January 1st and not necessarily like the balance that we're seeing. And, to kind of bring a little perspective, everyone, I've got the pleasure of talking to a myriad of people every day, pre-retirees, in retirement, young professionals, business owners. And the one theme based on 2020 specifically that got brought up more than anything last year is debt. And it's been very interesting because, as you well know, we're in a historically low interest rate environment. And people are really starting to think about the debt that they carry, and through that debt, which is the debt that they should be attacking and getting the balance paid down, and what's the debt that we would all probably consider good debt. And from a priority standpoint, one of the things that I find important, we follow the Board of Certified Financial Planner curriculum, and if we're planning the right way for our clients, there's really, when you think of a financial advisor, you think of investing, savings, offensive planning. But, as you know, we have to start with defense. And, we call it risk management. And just kind of using that sports analogy, going into a game, doesn't matter how great your offense is. If you don't have a defense on the field, you're probably not going to win.
Right.
So we like to take care of some of the risk management planning, estate planning, insurance planning with our clients first. But then that's when the debt comes in, because a lot of people feel that once that's taken care of, they jump right into saving and investing. But we call it basically optimizing, right? If we have free cash flow, what is the decision that we make of how much goes to paying down debt and how much goes towards something that's going to actually appreciate?
That's a lot to swallow right there. But I would say right off the bat, what I'm thinking too is most people are, how am I going to prioritize my debt? And I think, and this is something I've worked with you on this practice, Mark, and learned from partnering with you is, let's look at where the bleeding is right off the bat. And most consumers out there are going to relate to the credit card debt being number one, basically because it's typically the highest interest paid that you owe. So that's why most people don't ever get those balances down. They're just stuck at 20, 25, 30% interest, and it drowns them. Minimum payments at $200-$300, right? And it doesn't tackle any of the actual debt. It's just paying interest.
Completely.
Paying interest to go backwards.
Yeah. And I would say on this section, I really want people to sit down and prioritize their debt by interest paid to start with. I think it's a really great exercise of what you owe. You list out, hey, $5,000 in credit card debt. I owe $12,000 in my auto loan. I either rent or own. This is what I owe on my mortgage. And look at the interest rates and really just take a little bit of time to see what the balances are and how much the minimum payment is. And I really loved hitting the highest interest first. Highest interest on any debt first should be your primary focus, in my opinion.
Right. And sometimes, people come to us and they say, hey, I've got 5 different credit cards, right? And they have different interest rates to them, but one's really, really high, so I want to pay that one off first. Well, what's the interest rate on that one? Because even though maybe your other ones are 30 or 40% of the balance of the limit, which, we've done credit shows on here and there's a lot you can Google on credit part of it, but the ratio of how much you owe relative to the limit on your credit account is huge. So sometimes people come and say, well, I'm going to pay this one off first because it's the highest balance. That's a great intention. However, if that one has an interest rate of 12% and your other credit cards are at 15 to 29%, let's divvy that up a little bit.
Yeah, that's a super good point. A lot of people get stuck on like, oh, I've got 10,000 to your point. Just still 0% interest on this 10,000 and they're wanting to pay that off, but they're paying 30 on a lower balance and they're sinking and still. So good. I love that you brought that up. Anything to add on that end, Mark?
Yeah. And you brought up a really good point, and it seems counterintuitive, but I think of the federal student loan interest moratorium that's going on right now. And a lot of my clients, kind of their first take is, hey, let's take advantage of not paying any interest and really chop down the balance. And yes, I mean, depending on your financial position, there's an argument for that. But if you're sitting there and you have $10,000, $12,000 of consumer debt, that's typically in the 20% interest, but even if you have a really low, car payment, 4% interest, we would absolutely, just if you believe in math, want to tackle that first, even though it seems counterintuitive if you think about it emotionally.
Yeah, I love that. And you brought up the car payment thing because that's a really relatable non-credit card, non-threatening subject, right? So what a lot of the auto loans that I look at on a credit report when I'm originating mortgage applications, I will see a very standard like 25 to 35 grand for an auto loan. Average in our area, newer cars working, right? That's a median guess. But typically you're going to be paying about $1,200 to $1,400 annually on interest only for that loan. So it's a really easy takeaway of like, well, I'm probably paying $1,000 or $2,000 in interest on my car. How could I use that more effectively? Am I going to invest that money into something that makes me more than what I'm saving on that? So I think it's a good perspective that you're paying a few grand a year on your auto loan. And if you're got $30,000 you've saved up and you want to dump it into, say, a stock, why aren't you attacking this first? I don't know, Mark, anything on that?
Yeah, and that's another really good point. It does really matter or depend on what they're trying to accomplish and what the first priority is. But before making any kind of decision, we always look at interest rates. And, it also, not even interest rates, what we would consider good and bad debt. Secured, unsecured debt. Now, that's one of those things that, personally for me, I think it's silly if people want to pay off their mortgages if they're sitting on a 2.7% rate. I mean, would you think that's silly being in the business? I mean, we are on the modern.
That's a whole nother episode.
But it is, but it's a fabulous point, and I couldn't agree with you more. And a lot of times people come to me and say, "Hey, Brie, I want to do a 15-year to pay off your mortgage faster." Why? Like, there are so many other things that you could use that money to invest in that will actually benefit you more from a financial standpoint than paying that off.
Absolutely. And really what you have to look at if you're considering this at your, on your own balance sheet is, looking at the end of the day, what is going to make the most sense mathematically. It's so hard because the emotion of like just debt doesn't feel good.
Right.
But I've just kind of made the personal philosophy decision that hopefully I'm always carrying some kind of debt at some capacity that's collateralized with an equity building vehicle that is growing faster than the debt that I'm paying. I feel like if that spread's always there, our clients are going to be in great shape.
Right.
Well, and I want to roll to, because that's the first segment. We just covered consumer debt. But the second segment here of 3 for the 3 things to impact your finances 2021, I am super excited for Brie Fisher, Mother of Mortgages, here to talk about kind of the family perspective, pandemic, budget changes, taxes. Give me what mama's got.
Thanks, Addie, and thanks, Mark.
Yeah.
So the past year, we've taken on, everyone, obviously, and parents have taken on immense and instant challenges, right? We have reduction in pay, possibly a loss of going from a 2-income household to a 1-income household, on top of the kiddos being home more often. Yeah. And what that means is the lights are being left on, right? The water's running more often.
Oops.
And those little guys snack all the time.
All the time.
All the time.
A lot of goldfish crumbs in my couch.
Always hungry.
A lot of goldfish. So, those expenses have increased while a lot of people have experienced reduction in the household income. So we've been, on pivot more than an NBA player with the basketball in Game 7 of the championship.
Love the sports drop.
Me too.
Fantastic.
Constant pivot. So first I want to say, you guys, well done, parents. Well done. Okay, you've gotten through the last year. We can continue doing this. We really can. And with that, sometimes it feels like I'm not doing this. I'm a colossal mess. We're not making this happen. But you know what? You are, and you're doing great. And in that colossal mess, sometimes some of us have taken on a little more debt in the last year to manage the challenges that we've had. So no matter what your current money situation is, I promise you that you can make beneficial shifts today that will improve your finances. So what I'd like you to give yourself, your household, 30 minutes, one time a week for the next 4 weeks. And I'm going to go through the next 4 weeks.
Hold on, I'm writing this down. 30 minutes.
30 minutes, one time a week.
One time per week.
For the next 4 weeks.
4 weeks in a row.
And I'm going to go through each week. And this is what I would really like you to do to try to, go back to the budgeting and such, even with all of the challenges and changes that you've had the last year. So the first one in week 1, I want you to spend 30 minutes and I want you to write down all of your expenses, every single one. Now you say, Brie, that's super easy, right? I've got my house, I've got, car, gas, food. No. This is the challenge, to write down all of your expenses. So oftentimes when people say, I don't know where all the money went, right? Or I don't know why I'm not paying off my debt faster. The reason is because so many expenses come up that we're not accounting for, even in our savings or emergency budget fund. And what I mean is doctor visit copays. Usually budgets don't include that. Grandpa's birthday, AAA memberships, Amazon Prime membership. Cost,
Prime. Everyone's got Prime.
Everyone's got Prime. And depending, that could be $100 a year, right, or so, which is flea medicines for your pets, right? We hardly count those in our budget. Yep. So all of these little things, what happens is when we're not accounting for all of those, you're actually taking on debt and moving other expenses around, which is increasing your debt to best manage those. So I want you to take a piece of paper, however you categorize things, write everything down, your housing, gas, car, every utilities, everything on one piece of paper. Times that by 12, right? So whatever you have every month, and that's a total. Then I want you to take another piece of paper, and I want you to write down all of the other expenses. Okay. DMV renewal, soccer registration fees, and soccer shoes for kiddos, haircuts, right? Things like that we don't normally put into our budget. We just put into an emergency fund, right? All that together, and then just leave it, right? That's all you have to do is just write it down in week 1. All right. Important. If you're coupled, I want you and your spouse to write it down separately, not together.
Ooh, I like this.
Right? This is a little thing I love doing in my own household because it's funny how, and we'll talk about this in week 2. So we'll leave it at that. Each and you and your spouse, write it down separately. Don't even talk about it unless, he or she needs to say, hey, how much is the car payment if they're not, making the payment. So don't even talk about it. Write down. Here we go, week 2. Week 2, I want you to compare notes with your spouse. Okay, so review.
To give a little time to.
Yes.
It's important.
I want
Simmer
you to,
time.
Absolutely, simmer time.
Simmer out.
Simmer out. So week 2, I want you to review your list again. Is there anything you forgot? Is there anything in the last week that came up that we have to add into that? Because that happens quite often, particularly right now. So I want you to compare. Now, I want to hear from you guys, right? Because it is so funny to see the spouses come up and say, oh my gosh, you're spending $200 a month in coffee. That sounds like a lot, but a few bucks a day adds up.
That really adds up.
It really adds up. Yeah. So this isn't a judgment time whatsoever. Be kind to yourself and your spouse. And, this is a time just to assess and move forward. So let's do that. But compare the two. And then after you've compared the two, I want you each to eliminate one expense. Ooh. If you cannot eliminate something, if you're down to the bare bones with what you're paying for now anyway, take 2 of them and see how you can reduce them in half. Okay? That's week 2. Now, week 3, I want you to have your most recent pay stub, your most recent W-2 and tax return with you. How much of a refund did you guys get last year in your IRS taxes? Okay. The average American gets a refund of $2,800 per year on their IRS tax refund. Mm-hmm. Now, beautiful. You guys, that's you're giving the government a free interest-free loan every year. They're not paying you at the end of the year a bonus. Thank you for being a citizen. That's your money. They're paying you with your own money. So let's take that back a little bit and see how we can use that to reduce our debt now and get further ahead. So once you have your W-2, your most recent pay stub and tax return, go to irs.gov and search for W-4 withholdings. There is a calculator in there that you can use to find out what you need to use on your W-4 with your employer to get zero back, as close to zero as possible. Mm-hmm. Here's why. The average tax refund of $2,800, right? If we divide that over the course of a year, it's $230 a month. $230 a month.
Covers all the coffee you need.
All the coffee or the extra pay down of debt, which is where we're going, right? Or goldfish. Let's say in the expenses that you have eliminated that you did in week 2 add up to $50 a month. I'm not asking you, not suggesting we eliminate a huge amount of debt, a little bit of it. Mm-hmm. So we've got $230 a month from IRS tax savings from changing our W-4 withholdings. So there's more coming home every single month to balance our budgets and to work on our debts and savings. All right. So we've got about $50 a month in expenses. Maybe you have less, maybe you have more. And we have approximately $230 a month from the IRS tax refund that now we're putting into our pockets instead of our government every month. $280, right? Let me give you an example of how you can use this. And of course, any of us, or your loan officer, financial advisor, tax accountant can help you with this as well. But if you have $280 more per month in your pocket, and let's say you have a car payment that's $400 a month, and you've got 3 years left on the loan. If you take that $280 a month and you apply it as a principal payment, additional payment on your car payment, you're going to pay that off in 18 months instead of 3 years. So what does this do? If I said to you, hey, if we take the W-4 withholdings, save a few extra coffees a month, and before Christmas of next year, you're not going to have a car payment. That's a pretty great situation to be in to help the family, piece together what's happened in the last year and continue to build wealth. That means that by the end of next year, you're going to have $400 more a month to play with, plus the $280 a month that we were saving to get there.
Yep. Plus less interest paid.
Less interest paid. And that's how we're going to pay that car off faster. So making those little adjustments, they should be able to be made for most families and no matter where your income or debt situation is. And then after that, that's 3 weeks. 3 weeks, guys. So an hour and a half, 90 minutes. Then I want you to wait 30 days and then come back after 30 days for week 4. And in week 4, you guessed it, we're going to review our expenses again. right? We're going to see where we are, see how we did the last 30 days, see what our spending was, see what our income was, and if there's any adjustments. And the key here is to review your budget and your expenses, your income frequently, because we all have income changes. We, have illnesses that come up, situations that come up. It's okay to get off track. I'm sure that all of us get off track. I know I've gotten off track before, but the key is to get back on track, and you can do this.
Yeah, that's a good point. Just to jump in real quick, I want to hear, Mark, what's your perspective with retirement people? Because everyone's at different stages of your life. You got me, millennial, no kids, married 5 years out of the gate. You got Brie, mother of mortgages, has the motherly perspective, family perspective. Mark, you get to deal with all different people. Talk to me about retirement and different stages in life. I'd love that perspective as well. We got you for a few minutes.
And honestly, I think it's really good just to touch on one thing that you mentioned. And it's tough because when people come in and talk to me, a lot of times it's more reactive than proactive, right? Mm-hmm. It's more like, oh my gosh, like I feel like I'm not doing something right. I feel like I'm leaving opportunity on the table. I should probably talk to a professional to get some perspective.
Sure.
And a lot of times I unfortunately don't really tell them anything that they didn't already know. But it's so tough because whether it's retirement savings or whether it's just shaving off a couple $100s a month of interest, it's so cliche, but Rome wasn't built in a day. And at the end of the day, we've got decades, especially our age, before we're going to be quote unquote retired. Mm-hmm. And at the end of the day, as long as you are winning the month, if you're just, even if it's $2, $10, $20, if you are slowly improving, you're going to turn around 5-10 years later and you're not even going to recognize your balance sheet. You're not going to recognize your bank account. But it's so hard because that process, most people are going to give up on it if they don't really remind themselves why they're doing it, because it is going to take a year to really feel that impact. So it's music to my ears that you said that, because that's also the same thing with retirement planning. And I think about last year as a really, really interesting opportunity for people to truly look at their spending, because, a lot of people spend money on vacation and going out to eat, going to bars, more social leisure activities. And it was truly a sticker shock for people when I was having my annual reviews. Like, Mark, I'm not going to lie, I was really scared this year, but I spend so much less money, and just by, staying at home, being a little bit more conscientious of where my dollars are going. And the number one thing I would say, Addie, to answer your question about how it's pertinent to retirement savings, the stat that I came prepared for to share with everyone today, because I wanted to think of something to, glean some insight. There's a study by Ernst & Young at the end of 2020 that says only 56% of people who are eligible to enroll in an employer-sponsored retirement plan are actually choosing to enroll. And usually what that means is that they are giving up free money. Because what I want to encourage, and Brie got me fired up, is I want to give some homework now, even though I won't be on next week. But if you are sitting at home or in the car and you are thinking about what Brie just said, and want to make some of those incremental changes, and you aren't enrolled in your retirement plan at work, please call HR, check your employee handbook, and see what it would take, what you need to put in to get the maximum allowable match.
Yeah, that's one easy call.
It's free money.
One easy email to HR or payroll. There's people that sit there and answer these questions, right, Brie?
One easy email, do your W-4 withholdings. Look at the 401k and sign up for the 401k. And then also, you guys, an FSA account. An FSA account, if you're taking money pre-tax and putting it in for healthcare and childcare, I've seen people save $1,000 a year just by doing that. And so great point, Mark.
Yeah, Mark, knowing that we only got a couple more minutes here, if you were to throw in two more things, what else is on your list of must shares, and then anything to say about self-employed individuals?
That's awesome, because that was my next point, because I feel bad. I work with a lot of business owners, entrepreneurs, and if they're watching me on the show, be like, hey, Mark, what about us? Like, we don't have a corporate benefits package. We don't have HR.
Right.
But,
my wife's HR. Right? Yeah, she handles it all.
You're not going to get a match, But another incentive that a lot of people don't think about is that retirement savings, the primary focus is that we're saving for retirement, having compounding interest work in our favor, and prepare for the future. But a lot of times people are more incentivized to save in retirement accounts for income tax reduction purposes instead of future savings purposes.
Yep.
And so, if anybody, any of my self-employed listeners out there if they've heard of a SEP IRA, it stands for Simplified Employer Pension, traditional IRA, there are mechanisms out there that you can put money in that's going to lower the amount of taxes that you might owe, especially if you're like myself that sometimes forgets to pay quarterly taxes. And, it's a good way for you not to have to write a giant check at the end of the year and put a little bit more in your pocket. Now, obviously, for compliance purposes, I am not a tax professional, so you should consult a certified public accountant. Yep. But I think this is worth you asking your CPA resource or anyone that's going to help you file your taxes.
Well, it's really important that everyone has an environment that they can trust and hear the real scoop. And we got to buffer some things with tax accountant or, you're a financial advisor, but we're not, we're mortgage advisors, but having an honest perspective. And man, it's just so impactful to hear the 3 summaries of organizing that debt, the mother mortgage approach with families, budget, like sit down and go through the 4-week steps. And I will never forget the simmer line. Make sure to assess simmer. I had that on my notes, simmer. That was a really good one. And then Mark's feedback on the retirement and making sure that you're taking advantage of any matchable employer stuff, reducing your taxable income as self-employed. So those are really awesome 3 steps, guys. I really am excited that we distilled it down, and hopefully there's some real takeaways here today.
Absolutely. And if you have any questions or need some advice, where can they reach us?
Yeah, we do have that VIP line number. I'm not expecting Mark to know it, but
I'm going to write this down.
Yeah, you can call or text us at any point. You could reach Brie Fisher, myself, the rest of the MLO team at 503-847-9038. And thank you so much for everyone joining us today on the MLO Show. Of course, Brie Fisher, Mother of Mortgages, thank you.
Thank you very much, Addie.
And then Mark, special guest, say goodbye, say thank you.
Brie,
you're out.
It was great to be on the show with you.
Yeah.
I'm looking forward to the 4th visit. Hopefully I can come back.
Absolutely. Love it.
Absolutely a blast. So until next time, everyone, we'll catch you later.